Katie Tur's going to pick up the coverage from Washington, but we got this Fed thing. Katie Tur.
You're staying because
stay here.
When there might be a federal interest rate hike, we need Stephanie Ruhle and Ali Velshi to help us. We need Velshi and Ruhle. So talk to me. We're going to find out.
My vote is there will be a rate hike.
So we're going to find out in just a moment. Stephanie, when you say no rate hike, do you think that's because the president's been pressuring the Fed, or is it because the market's been
Thanks, Katie, for asking that. I'm sending you $5 on Venmo.
I think there is a maelstrom of information, of data that they have realized over the last month and a half. But I do think part of the market panic has been one of the contributors has been the chaos created up.
Woo!
And I'm wrong.
I won $5.
A quarter of a percentage point.
I'm not happy that interest rates are going up. I'm just telling you.
A quarter of a percentage point.
25 basis points. 1/4 of a percentage point, as they said they were going to do.
Okay, so tell me, Ali Velshi, what does this mean? What happens now?
So I think the Fed, given all, this is where I'm on Stephanie's side of this, given all of the data that it has been able to read it all and say the economy is strong enough to withstand one more interest rate to get to get rates higher, so that in the event of a slowdown, the Fed has the ammunition necessary to deal with the economy. Remember, when there's a slowdown, the Fed lowers rates to try and boost the economy.
They need to have that cushion.
They're filling up the gas tanks. They filled up the last bit of gas tank.
If rates are super low and we face a recession, they have no other levers. They can't turn right or left.
Yeah.
Yes, they have to be able to lower rates and create that, soft cushion that Janet Yellen, we saw her hold on to throughout the Obama administration. And if they don't have a way to move down, there's nowhere to go.
But
so it's a B12 shot, essentially.
Yeah, and the question is, and we're going to hear in a little while from Jay Powell, the head of the Fed, what he thinks happens next. Are they kind of done? Do they feel that this is where interest rates need to be for a little while? Do they even talk about maybe lowering interest rates if the economy softens up? So this is always a two-part equation. One is what they do on rates, which they've just done. They're increasing them by 1/4 of a percentage point, and what they say about it.
And who's going to be, break down the real world impact. What does this mean for getting a mortgage? What does this mean for savings? Give me everything.
So
credit cards.
Everything. There's something called a prime rate, which used to be if you were a bank's best customer, you pay the prime rate. The prime rate is always 3% higher than whatever the Fed rate is. So what this technically does is if you have a loan that moves around, that's variable, you may see an increase of 1/4 of a percentage point on everything you pay. Now, mortgages, which is really where most of the money is.
And we've already seen home builders get hurt in the last few months as people are anticipating it becoming more expensive to buy a home.
So the Fed rate the Fed doesn't directly have an impact on your mortgage, but bond rates move around the same way, or very similarly to how the Fed rate does move. So you're going to see you see them push up in advance. So it's obviously more expensive now to get a mortgage, a 30-year fixed mortgage, if you have good credit and you put down 20%, than it would have been a year ago.
But when rates
so what does this mean for the
low,
housing market? Does it mean it starts to go down, prices?
Well, it makes buying a home more expensive, so that's not a positive for the housing market. Remember, when they lower rates, one of the reasons they lower rates is because they want to incentivize people to go out and borrow, to start businesses, to buy a home, to buy things to improve their homes. But when rates are super low, that's not great for savers. And from an investing standpoint, the only game in town is stocks. That's one of the reasons for the last 10 years or so, people were piling into stocks.
Yep.
And the president railed against Janet Yellen and President Obama when he was in office, saying, think about all those savers, those senior citizens on fixed income.
So they're doing a little better today. Now your savings rates will go up. But to your point, Katie Tur, that if you're buying a house and you're not taking a mortgage, then yes, this is good for you, because home prices will go correct.
Yeah, there's almost nobody doing that.
Correct. So for most people, the increased cost of the loan is more consequential than the decreased cost of the home. Take a look at the market now. It was up 200 and some points when before this decision. It's still up, which is all right.
It's still up because, remember, it was expected. And one thing that we know that the market likes is regularity. When there's an expectation, they like it to be met. The market doesn't like to be surprised. So, yes, you've seen it peel back a little, but you're still in positive territory.
Yeah.
Well, guys, thank you so much for helping us understand this, and thank you for sticking around an extra 4 minutes into what is Ali Velshi's lunch hour.
Thank you very much. 56 minutes.
See you later.
Bye-bye.
Hey there, I'm Chris Hayes from MSNBC. Thanks for watching MSNBC on YouTube. If you want to keep up to date with the videos we're putting out, you can click subscribe just below me, or click over on this list to see lots of other great videos.